the Rebel Capitalist Show.
We talked about the supply side of Bitcoin or gold, but I think a lot of people would push back with the demand component. And because let's just talk about full reserve, whether it's gold or Bitcoin, because you didn't have much elasticity with the money supply, there could be all of these projects out there that could increase productivity, because we talked about debt, but more so focused on consumer debt, where if you do have debt that's productive, where we're creating more goods and services with that debt, it isn't necessarily inflationary. In fact, it could be deflationary. So is there a way with an asset that's completely scarce to solve the problem of elasticity as well as scarcity? Do you have to choose one or the other?
Well, I think the free market has a mechanism built in for this as well. If we consider Bitcoin is eating all the world's money, we're on a hard money standard. That Bitcoin now is no longer appreciating 100% year over year. It is appreciating in line with global productivity growth.
Right.
So it becomes your new hurdle rate. Whereas today our hurdle rate is the inflation rate. We need to be generating cash flows that outpace the inflation rate to be accretive to our business or our household. We now have this hurdle rate that's much lower, which would just be the general productivity growth that's accreting to that hard money. So say it's 2%, 3% per year. Now, all of a sudden, it may make sense to lend your Bitcoin to these projects that are predicting to return 5% or 7% per year. Whereas in a debt-based economy, that wouldn't be feasible, right? You're not gonna, if money supply is inflating 15% a year, a project with a 7% expected internal rate of return is not going to get funded. Whereas on a gold standard, it might. So I don't know that the elasticity argument holds up for me. The other piece is that savings underpin investment, right? So today, the more savings we have, the larger the pool of that savings, and the less productivity is growing in the world, the lower that hurdle rate is, the more incentive there is to lend into the market for these projects that can improve the human condition, frankly. But I think the interest rate becomes the mechanism that governs this, right? It's the supply and demand of money. So if there's a higher demand for money, the interest rate will increase such that it incentivizes savers to lend to projects. So I think that the natural interest rate is the answer. Again, we don't have a clear-cut picture or historical example of this because of all the manipulation in the market for money.
All right.
But the free market solves everything else. Why would it not solve this too? So I don't jive with the argument that we need elastic money or we need this debt relief. When things do contract economically, we need to paper over the losses with QE. Like, I don't think any of that is the answer. I think it actually exacerbates the problem, exacerbates the business cycle itself. And then I could jump into a few of the other demand drivers for Bitcoin. One, I think that is just very underappreciated is that, and we think about it like this, gold was energy money. What I mean by this is that any productive effort in the economy that couldn't be expected to increase productivity more than you could spend that same energy going to mine gold would just be allocated to mining gold effectively. So it became this floor for the allocation of human energy. And the other way to think about this, and I got this from my discussions with sailors, that you can think of money actually as the highest form of energy that humans can channel, because it is a claim on all other productive efforts. So if we can make a nuclear plant and make nuclear energy, money's a claim on that. If we can tap into the earth and harness geothermal energy, money's a claim on that. If we can build a dam and generate hydroelectric energy, money is a claim on that. So money is this meta claim on any energy that humans can harness, if you will. So gold, again, the scarcity of gold was mapped directly onto the energy necessary to extract it from the earth. And even when we went off the gold standard, we saw the US dollar needed to move to this petrodollar standard, right? So they had to move away from gold to black gold, because black gold is the energetic lifeblood of the industrial economy. So there's always this very close relationship between money and energy. And when we look at Bitcoin through that lens, it's the first system in the world that allows us to directly monetize energy. So that's what Bitcoin mining is. It's anywhere in the world you can find marginally cheaper energy. You can put a Bitcoin miner on top of it, or Bitcoin miners, and turn it into digital gold, into a globally transactable money. So it's a way, instead of going through, say, the gold mining process that goes into these layers of intermediation before you kind of have the US dollar, which is a proxy for energy, we have this means of directly monetizing it. So we go directly from energy to a globally transactable final settlement network that is Bitcoin. Every country, every individual, every institution in the world, there's a race to the bottom now in Bitcoin in terms of energy prices. That a couple of ways to think about this. One is, you could say Bitcoin is a perpetual global bounty program for unused and underused energy resources. The visual I like that Nick Carter supplied is, if you imagine the Earth as a sphere, like a topographical map, with lower cost energy being lower points and higher cost energy being higher points,
Right.
Bitcoin pouring a glass of water on that sphere. So it settles into the lower cost energy areas and turns it into money, basically. This is a massive demand driver. Like in the US alone, we've talked to some energy executives here. The way one guy put it that I absolutely love, he said that the entire North American energy grid was constructed and designed for one hot afternoon in August. So there's so much slack in this system where there's excess production capacity not being used, right? It's either being curtailed, which is just outright wasted, or it's being turned off. I think Bitcoin is going to be a great adjunct for energy producers going forward to monetize a lot of wasted energy. So this, I think, is an irrefutable source of demand going forward. It's anyone that has access to energy that's not currently being monetized, they're going to have this direct incentive to transmute it into digital gold.
How do we get to a point with Bitcoin where it's more transactional?
In terms of day-to-day transactions?
Yeah. Like we're using it as a currency.
Yeah. So we touched earlier on the custodial functions of a bank, right? So if a bank is holding Bitcoin, they can then issue their own, in a free banking society, they'd issue their own bank notes or bank tokens that were backed by Bitcoin. So here's the main premise, is that Bitcoin is optimizing for survivability. That survivability, the cost of that is a ton of redundancy. Bitcoin is pure redundancy, essentially. Right. It's every node is the whole network. With that, the cost of that redundancy is it's slow, right? It takes a while for this global network to reach consensus. The other end of that spectrum is a centralized ledger like PayPal, Venmo, the Fed. They're just updating a list once, right? Like right. The list changed, so they can do it lightning fast. I think you can get a dynamic of this decentralized and centralized ledgers through these bank models we talked about. But there's also a lot of promise, and it's not proven yet, but with things like the Lightning Network, which are a layer 2 protocol to Bitcoin that are sort of satisfying this transactional function through smart contracts. So it's a way to put Bitcoin in a software channel. The rough analogy is this: it's if you and I open a Lightning channel between one another, it's like we have an abacus between us. You've put in one Bitcoin, I put in one Bitcoin, and now we get to slide beads back and forth across that abacus. And one of us have the option to settle to Bitcoin main chain at any time. So we can pull final settlement down at any time. And the Lightning Network is just a network of those abacus connections across the world. So you can move Bitcoin at zero cost, basically instantaneously anywhere in the world. And an interesting project there too is Jack Meller's Strike. I don't know if you've seen that yet. He did a piece from Fish recently. It's very promising. It could lead us to this world of streaming money or a money over internet protocol. But we do need a balance between that decentralized ledger that is network and the centralized ledger that would enable fast transactions.
Okay, I listened to you talking to Preston, in fact, and you were saying that what you're doing, or maybe what you were doing in 2020, was incredibly difficult because your fund was trying to trade Bitcoin and actually produce higher returns than just holding Bitcoin. You're like, this is really hard. But you guys were talking about how to reduce the volatility in Bitcoin by making sure that it's an appropriate size in your overall portfolio. And with my partners in Rebel Capitalist Pro, Chris McIntosh and Lynn Alden, we're always talking about how important portfolio construction is and how the average Joe never thinks about it. The only thing they think about is just this one asset. Is it going up or down in price? And I always argue that that's probably the last thing you should be thinking about. The very first thing is, how is your portfolio set up to make sure that you have a mathematical edge over the long run. And so could I get your thoughts on that? Because when I'm on Twitter and on the comments of my videos, sometimes you get all these people that are 100% in gold or 100% in Bitcoin or oil or whatever it is, and they're buying gold on their credit card or Bitcoin on their credit card. And I'm like, guys, you're just asking for problems there. But what are your thoughts on that?
Yeah, I think as a student of the market, humility is the most important virtue. Like, no matter how ideologically or emotionally bought in you are into any asset, you need to think pragmatically first.
Right.
And I agree that pragmatism is expressed in portfolio construction. There's no such thing as a too volatile asset. I think that was the argument I had with Preston is people that say Bitcoin's too volatile. It's like, then you have too much of it in your portfolio. Like, reduce the position sizing wherever, because there's a way to structure that portfolio. If it's 0.1% Bitcoin and 99.9% treasuries, that's your volatility profile. That's great. It doesn't mean you have to exclude Bitcoin because it's quote unquote too volatile. So yeah, that's investing 101 in my mind, is that volatility and position sizing go hand in hand. And then you could also add into that diversification, right? As far as if these things are counter-cyclical to one another, then you can get a higher Sharpe ratio in your portfolio, which is just risk-adjusted returns. So yeah, always trust that the market knows more than you. So I think listen to the market, despite whatever, like, clearly I'm way down the Bitcoin rabbit hole. I'm largely allocated into Bitcoin, but I'm still listening to the market all the time. I'm never believing that I've got it figured out over the market. So.
Yeah, well said.